Bitcoin holds above US $100,000, while global stocks and bonds are mixed overnight ahead of key US jobs figures that may decide whether the Fed cuts again. The euro is holding up well despite the collapse of France's government, and Australia's imports of consumer goods ticked up in October as retailers stocked up for Black Friday. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at how Indonesia can grow GDP even faster than its current rate of 5% per annum.
Now, the goal, however, is to accelerate this growth rate such that Indonesia can become an upper middle class economy, if not a rich economy, by 2045.
But first, in 5 and 5 with ANZ, aside from the celebrations around Bitcoin surpassing $100,000 yesterday, global stocks and bonds are on tenterhooks ahead of tonight's non-farm payrolls report in the United States, which may well decide if the Fed cuts again later this month. ANZ economist in London, Bansi Madhavani, says the markets are expecting 218,000 new jobs in November and for unemployment to remain unchanged at 4.1%. She details what it would take for the Fed to pause.
If the payroll addition is higher than 250,000 and if the unemployment rate falls to 4% or below, we think the risks will skew towards the FOMC pausing at its December meeting. That's certainly not the base case for now. Currently, markets are pricing over 70% odds of a 25 basis point cut in December.
In markets, the S&P 500 was flat and the Nasdaq was up 0.1% at 4 a.m. Sydney Melbourne time, while US Treasury yields rose between 4 and 6 basis points. The US dollar index was down about 0.4% after the euro was surprisingly resilient in the face of the collapse of France's government. The euro was up 0.5% to 105.72 US cents. The Aussie and Kiwi dollars were both firmer against the soft US dollar. The Aussie up 0.15% at 64.38 US cents and the Kiwi up 0.38% at 58.73 US cents. Number 2. It's been a good month for Australia's trade surplus, which rose $1.6 billion to $6 billion in October. Here's ANZ Australia economist Sophia Angala.
October's print is the strongest trade surplus we've seen since February. The increase was driven by an over 3% rise in export values, which outpaced just a small rise in imports. Resources exports grew just below 2% in the month, driven by an over 15% rise in other mineral fuels, which includes exports such as LNG. But this was offset by a fall in coal exports.
Number 3. Sophia says imports were flat overall, but there was a 0.8% rise in imports of consumer goods in October, suggesting shoppers were gearing up, at least for a bargain.
So this could be reflective of retailers stockpiling inventories ahead of Black Friday sales in November.
Number 4. There's good news this morning for dairy farmers in New Zealand, with ANZ Research increasing its farmgate milk price forecast for the 2024-25 season by 85 cents to $9.85 a kilogram of milk solids. $10 here we come. Here's ANZ New Zealand agricultural economist Susan Kilsby.
Basically, there's a global shortage of milk at the moment. Milk is reasonably tight, and we just haven't seen any major growth in any of the big dairy producing regions for a year or two. And so it's just the market's just tightened up. Demand isn't fantastic, but the two have balanced themselves out, and it's now certainly working in favour of exporters, particularly New Zealand exporters who are exporting the products that are in high demand. So whole milk powder and the cream products, butter and AMF, are in really strong demand at the moment, and they're the products we export, so that's working out really well.
Number 5. Susan says, however, that farmers aren't counting their chickens yet, though, and aren't planning massive expansions of land for dairying.
We're seeing a little bit more milk being produced in New Zealand this year, but that's really mainly just due to good weather conditions. So pasture growth has been good and we're getting our sort of usual year-on-year productivity and genetic gains, but not really being driven by higher prices. Very much farmers are still in the mode of if they have extra funds available, they are looking to repay debt rather than expand at the moment. So we're not really expecting to see a huge amount of expansion in New Zealand's dairy industry in the next few years.
Susan Kilsby there. Now, in our bonus deep dive interview, ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, talks with my colleague Alex Tarrant about how Indonesia can grow GDP even faster than its current rate of 5% per annum.
Indonesia has had a remarkably stable growth rate. If you exclude the pandemic period and the post-pandemic recovery, what we notice is that we've had growth of 5%. And to the credit of the Indonesian policymakers, this growth rate has been very, very immune from global developments. Now, the goal, however, is to accelerate this growth rate such that Indonesia can become an upper middle class economy, if not a rich economy, by 2045.
And so just given that goal, what do they need to do?
On a cyclical basis, one of the developments that we've seen is that discretionary spending by households has really been moderating. And there are some measures they can take, which at the same time have a limited efficacy. The first is that the government is planning to increase the salaries of civil servants. It's planning to increase minimum wages. And the second, which I think has longer term benefits as well, is to really introduce a free meal program for students. We've seen that in India, this was very successfully implemented. It not only increased school enrollment, but it really helped improve nutrition levels and eventually productivity among school kids.
Structurally, what is needed in terms of those building blocks or institutions in Indonesia's economy?
I guess that is best laid out by the sort of situation we have in Indonesia. So there are two constraints. The first is that the capital intensity of investment in Indonesia has been very high. That's because of higher logistics costs, infrastructure in general, as well as the fact that the emphasis has really been on capital-intensive industries such as construction and mining. So the first and foremost thing is that we need to get more out of this investment, i.e. that reduce the capital intensity, create more employment-related projects, etc. And that can be done by focusing on labor-intensive industries such as textiles, garments, shoes, the typical manner in which many of the economies in Asia have transited to middle income and higher income levels. The second handicap is that, of course, you have to get more imported capital to support growth. And that sort of needs an easing of FDI regulations in terms of smoothing processes, etc. Because you cannot simply run a high current account deficit in Indonesia, because one of the key policy objectives, or rather monetary policy objective, is to ensure that the currency remains stable. So the only way to sort of overcome this barrier is to get more long-term capital into the economy.
Is there much they can do in the very short term to make sure that this goal out to 2045 is achieved?
I wouldn't think that geopolitics is a major issue, but there are other handicaps as well, or constraints, if you like. So if they were to raise consumption, there are two sort of issues here. First of all, during the COVID period, households had depleted a lot of their savings. So the first, if let us say disposable incomes do increase, the odds are that a good part of this would be channeled into rebuilding savings. The second is that whenever we've seen a minimum wage hike in Indonesia, it's not as if average wages across the economy go up. They just rise by the amount of minimum wages. And similarly, if you increase salaries of civil servants, in an ideal situation, that should increase wages across the board. But that doesn't happen in Indonesia. So these are two very powerful constraints that will limit the short-term boost to growth.
Sanjay, Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, December the 6th. Catch you next week with analysis of non-farm payrolls, and we look ahead to the Reserve Bank of Australia's next rates decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.